China currently holds an estimated $3.2 trillion in U.S. dollar assets, including treasury bonds, corporate bonds, currency reserves, mortgage-backed securities, and equity stakes in American companies. This is more than any other nation, surpassing Japan, the UK, and even the combined holdings of Europe. For years, analysts, politicians, and financial commentators have warned of a potential scenario where China could weaponize these holdings. The fear is that if China decided to sell off their entire stash, the dollar could plummet, interest rates could skyrocket, and the U.S. might face a severe fiscal crisis. Such a move has often been referred to as a financial nuclear option, a theoretical weapon capable of shaking global markets to their core. Yet, despite the looming threat, China is effectively trapped. Dumping these assets would not just harm the U.S., it would devastate China's own economy far more severely. The $3.2 trillion in dollar holdings is deeply entwined with Chinese financial system, accumulated over decades through trade surpluses and dollar inflows from global exports. It's not a separate liquid asset that can be casually offloaded. Attempting to do so would trigger catastrophic losses across corporate bonds, mortgage-backed securities, and currency reserves, potentially wiping out hundreds of billions of dollars and sparking a domestic financial crisis. To understand why China can't simply sell, consider the broader consequences. The Treasury market would be overwhelmed by a sudden flood of $731 billion in U.S. government debt. Prices would collapse, yields would skyrocket, mortgage rates would spike, and the American housing market could freeze. Consumer spending would fall, corporate borrowing would be crippled, and banks would face solvency challenges. The Federal Reserve would have no choice but to intervene by injecting massive liquidity, creating runaway inflation. In short, the U.S. would face a severe economic shock, but China's own exposure means it would suffer even more. A collapsing dollar would instantly reduce the value of China's remaining $2.5 trillion in dollar assets. Its export-dependent economy would take a massive hit as American demand falls and the yuan surges in value, making Chinese goods significantly more expensive abroad. Dollar-denominated corporate debt would balloon in real terms, leading to widespread defaults, bank failures, and soaring domestic inflation. Energy imports, priced in dollars, would become far costlier, compounding the economic strain. In essence, the $3.2 trillion isn't a weapon, it's a trap. China is locked in a high-stakes financial stalemate with the United States, where any aggressive move could lead to mutual destruction. Recognizing this, China has spent the past 15 years seeking gradual ways to reduce its dollar dependence without triggering a crisis. This strategy involves three key components: gold accumulation, creating alternative financial infrastructure like the Cross-Border Interbank Payment System, or CIPS, to bypass the dollar-based SWIFT network, and forging currency swap agreements with dozens of nations. These efforts allow China to settle trade in yuan rather than dollars, slowly reducing the need for dollar reserves. At the same time, China is attempting to rebalance its economy away from reliance on exports, shifting toward domestic consumption. However, these changes are painstakingly slow. Global trade is still dominated by the dollar. International markets remain dollar-centric, and legal enforcement under U.S. law still favors dollar contracts. As a result, even with these long-term strategies, it could take decades for China to significantly reduce its dollar exposure. Meanwhile, the trap remains active, and both nations are forced to navigate this delicate financial standoff with extreme caution. The slow-motion unraveling of this dynamic is already underway, and the stakes could not be higher.
China has been pursuing a long-term strategy to reduce its dependence on exports and increase domestic consumption, a policy officially in place since 2013. The goal is to raise consumption's share of GDP from 38% to 60% over the next 2 decades. To achieve this, the government has invested in infrastructure, expanded social services, raised wages, and shifted focus from investment and exports toward domestic consumption and service industries. Progress has been steady. Consumption's share of GDP has grown from 38% in 2010 to roughly 55% in 2025. However, this shift brings new challenges. As wages rise, China's labor advantage erodes, making its exports less competitive. Manufacturing increasingly migrates to countries like Vietnam, Bangladesh, and Mexico, and China's trade surplus has fallen from a peak of $400 billion in 2015 to $250 billion in 2025. While this slows the inflow of new dollars, it doesn't address the existing $3.2 trillion in dollar assets, which still binds China in a trap. Reducing these holdings is necessary to escape, but selling aggressively would destabilize the dollar and destroy China's own economy. The attempt to diversify away from dollar dependence began in earnest after the 2008 financial crisis, when Chinese leadership recognized the fragility of the global dollar system and their overexposure. Since then, gold reserves have surged from 600 tons to at least 2,300 tons officially, likely closer to 5,000 to 6,000 tons in reality, while the share of trade settled in yuan has risen from virtually zero to around 7%. Treasury holdings have declined from $1.3 trillion in 2013 to $731 billion as of July 2025, and domestic consumption has gradually replaced a portion of exports. Despite these efforts, China has only made about a quarter of the progress needed to fully escape the dollar trap. At the current pace, complete diversification could take another 20 to 30 years, pushing a true escape to somewhere between 2045 and 2055, when dollar holdings could theoretically fall below $1 trillion. Yet the real challenge is the fragility of the dollar itself. The U.S. is accumulating debt at roughly $2 trillion per year, with the national debt reaching $38 trillion by late 2025 and annual interest payments nearing $1 trillion. Inflation persists, the Federal Reserve has printed trillions, and the dollar's position as the world's reserve currency is slowly eroding. If the dollar collapses before China fully reduces its exposure, the losses would be catastrophic. This creates a tense standoff. China cannot sell dollars without self-destruction, but holding them leaves it vulnerable to a dollar collapse. Meanwhile, the U.S. is constrained in its policy toward China. American policymakers know that China's $3.2 trillion dollar holdings are a form of deterrence. Unlike Russia, whose $280 billion in dollar reserves could be frozen without immediate global fallout, China's reserves are so massive that any aggressive action by the U.S. could provoke a retaliatory flood of dollars, triggering mutual economic damage. In effect, both nations are trapped. China's measured approach, selling only small amounts of treasury bonds and slowly shifting trade to yuan, is designed to avoid panic and prevent catastrophic market reactions. For now, this slow adjustment actually stabilizes the dollar in the short term, as the controlled pace prevents sharp spikes in interest rates and allows markets to adapt gradually. However, structural vulnerabilities remain. The dollar's share of global reserves has been declining steadily, from 72% in 2000 to around 56–57% in 2025, and could fall below 50% by as early as 2028 if current trends continue. Once that tipping point is reached, the transition away from the dollar could accelerate rapidly, triggered not by China's actions, but by market dynamics. The irony is that the dollar-China relationship was originally mutually beneficial. Over 4 decades, China's industrialization and export-led growth created cheap goods for American consumers, lifted millions out of poverty, and fueled massive profits for U.S. corporations while keeping U.S. interest rates low. Yet the very mechanisms that generated prosperity, China's dollar accumulation and the U.S.'s reliance on cheap imports, also created this complex trap. Today, rising labor costs, unsustainable U.S. debt, and the erosion of financial advantages mean that both nations face immense risk. Neither can exit the system without significant costs. They are like two climbers roped together on a cliff face. If one slips, both fall. Looking ahead, the next 5 to 10 years will be critical. China will continue diversifying through gold purchases, expanding yuan-based trade agreements, and promoting domestic consumption. Meanwhile, the U.S. will continue deficit spending, printing money, and allowing inflation to persist. The dollar's share of global reserves will likely continue to decline, potentially reaching 50% or lower. From there, the world could move towards a multipolar currency system, with regional currencies and gold-backed trade mechanisms gaining prominence. The exact outcome is uncertain, ranging from a managed transition to a chaotic crisis or even mutual economic collapse. Regardless of the scenario, the $3.2 trillion dollar trap remains the defining financial dynamic of our era, shaping global economics and threatening wealth on a scale unseen since the Great Depression. For individuals, the lesson is clear. To protect assets, one must look beyond dollars and yuan, to gold, cryptocurrencies, hard assets, and productive businesses, all of which exist outside this geopolitical and financial standoff.